In my office to first put himself on mute so that the audio doesn't spill over. Yes, now we have proper audio. This always happens, or this can happen sometimes. Viewers, welcome to the Mutual Fund Show. Thanks so much for tuning in. I'm Niraj Shah. And over the next 20-25 minutes, we'll talk all about mutual funds, some particular aspects of mutual funds. Two guests on the show today. Swarup Mohanty is a guest on our show many times, and it's always a pleasure having you, Swarup. Thank you so much for joining today, and I hope all is well.
Yeah, all is good. Thank you for having me on the show. Always a pleasure being with you.
Thank you, Swarup. And for the first time on the BloombergQuint platform, Salonee Sanghvi joins in. Salonee, great having you, and thanks again for thanks to you as well for joining in today.
Thank you so much for having me, Niraj. It's great to be here with Swarup.
Yeah, thank you. Okay, so viewers, this is what we're gonna do. We're first gonna bring in about a 10-15 minute conversation on this debate that continues always about static versus dynamic allocation and what is best suited for you as a mutual fund investor. So we'll try and simplify it as much as we can. Swarup Mohanty has got a lot of thoughts on it. I'll also ask Salonee to come in and try and see if she has a different point of view there. And post that, we'll do two other things as we have told you we will, which is that we will talk about short-term debt plans and what's the best product available out there in the market, the category and funds within that category maybe. So we'll do that. And because Bank Nifty is on a bit of a tear, we'll try and put Salonee in the hot spot by asking her, is there a fund or a set of funds which can be bought into by which you can make the most of possible upsides in the banking space? But first, the key thematic discussion for the show today, static versus dynamic asset allocation. Swarup Mohanty, tell us, opening thoughts from you. Where are you on this? Let's not call it a debate, but where are you on this argument?
See, on the argument, not only me, but my fund house stands very clear on the debate. Being invested to your asset allocation always is a superior strategy. Looking at the market and trying to time the market never works in the long run. There is enough study and enough results which say that as long as you stick to your asset allocation and do a review and rebalance periodically, and that review and rebalance has to be very, very thorough and uniform across the time frame, the results are dramatically higher than any market timer. So I'm very clear that static allocation is a superior tool because yes, it's boring, so it may not appeal to many people. Dynamic is always the romance side of knowing about tomorrow and acting today. But in the fields of investing, more often than not, you're always caught on the wrong side because the market is dynamic. The market is definitely smarter than you.
It's interesting you say this, Swarup. So I'll first get onto the how, and then we'll talk about the why as well, because there's a lot of questions around the why. I'll get Salonee in that debate as well. But first, the how. Now, how do you recommend people go about doing this? Are you to just simplify this? Are you saying that what people should ideally do, that if they've taken the decision to invest when they have the money, go out, invest the money, like fill it, shut it, forget it? Is that the principle that you're advocating right now from a mutual fund investor's perspective?
Anybody, when you invest, and especially when you're investing across asset classes, it's a very simple planner rule that you allocate a certain percentage to a certain asset class. Because typically, the assets are cyclical, they have their own play. So it's better to be invested across asset class. So suppose, just for simplicity, let's take debt and equity as two asset classes, and I have decided that I'll be 60-40 or say 70-30. Now I follow that 70-30 rule as my benchmark, right? And suppose I do a yearly rebalance. At the end of every year, I see where that 70 stands. Suppose it's gone up to 75, I rebalance it back to 70. That is how a static allocation works across asset classes. While a dynamic asset allocation might look at other factors in the market or the changing dynamics on the market and reflect on the asset allocation. Some take it the PE-PB route. If the P is expensive, then they would cut asset class or take various routes. Or some, follow the cyclical way. If the market goes high, they increase their equity portion, and when it falls, they cut their asset. And some just remain tactical at their own whim. They allocate differently. But the simpler and the more powerful way, according to us, and that's why we are a fully invested fund always. For us, 2 to 3% cash in an equity fund is a lot of cash, irrespective of market cycles. I mean, it's very interesting that if you look at the overall market this time post the comeback in April, it is per se that the entire market was fully invested, that they caught the entire J curve of the market. If you reflect on the same situation in 2008, 2009, a lot of funds went into cash because that's what is supposed to be done when markets fall down. But on the rebound, a lot of funds did not catch it. So fully invested strategy, as per your asset allocation, in the long run has its own merits.
Yeah, well, so I have to admit that I concur with you on one part out there, Swarup, which is that nobody can time the bottom, and the bottom belongs to the person who is invested, because it's virtually impossible for maybe 95% of the market to be able to catch bottom. I doubt too many people caught 7,500 on the Nifty in March and then made hay now. But just before I get Salonee in this conversation, so just a quick follow-up there. You are basing this not just on the theory that you guys have within the fund, but I think there is some study or research you've done, and I was wondering to get from you the data as well out there, wherein you are saying that actually aggressive hybrid strategy has worked better than dynamic asset allocation.
See, data has to be historic, so I'm quoting historic data. You take this data, 1 year, 2 year, 3 year, 5 year, 3 year rolling for that matter, in all circumstances, as on date, of course, the aggressive hybrid would outperform the dynamic asset allocation plans. Yes, one can debate that when market falls, the dynamic asset allocation typically outperforms the static allocation, but in a falling market anyway, you're not making money. You invest to make money, right? So when the markets normalize, and I would say a 3 year rolling return is a very interesting time frame, check that data and you be the judge.
Okay. Salonee, you want to come in? Can you just tell us a bit about for how long have you been doing this, and what is your view on this? Like I said, not a debate, but an argument.
So I have been in the financial services industry for over 16 years in various roles, including equity analysis. I was working with Rakesh Jhunjhunwala for 8 years. And then that's when I realized that there's a huge gap here in terms of solid, unbiased advice. And, I decided that wealth management is the space where I want to be. I agree with Swarup that, obviously your asset allocation is very important, and it's decided based on the risk profile of the investor. But I would also add in one more feature, which is also your duration to goals. For example, if someone has an aggressive aggressive risk profile, but the goal is in the next 3 years, then they should not be probably investing 60, 70, 80% in equity. So ideally, I would prefer, I recommend as well that you kind of break your debt and equity investment. Instead of having one fund, have 2 funds or more do that for you. But in reality, what happens is a lot of people don't really, especially new investors, don't follow asset allocation. So for them, obviously, an asset allocation fund can be a good introduction to equity. And also because they lack, discipline to rebalance their portfolio as and when needed because of various circumstances. So I feel asset allocation funds are great for new investors that are entering the market. That being said, I prefer dynamic asset allocation funds because what happens is in equity, for me, the most important principle is protecting the downside. If you can protect the downside, then the upside takes care of itself. Which is why I like trend following dynamic funds, which kind of protect your downside, but then also give you, a large portion of the upside as well.
Okay, here, let me try and get some data here, right? Because while under normal circumstances, and we've had multiple fund houses come out and speak about the benefits of dynamic asset allocation. There are multiple funds again out there, viewers, and therefore, and you would tell me then on Twitter that, hey, Niraj, a few shows back, XYZ gentleman had come in and spoken and gone to great lengths to explain the benefits of dynamic asset allocation. Why is it that right now you're talking about this? So there is a bit of a history out here, and we'll get that slide up on the screen, of course, about how if we look at 1 year, 2 year, 3 year, 5 year, and 7 year timeframes, actually even 10 year timeframes, Salonee, aggressive hybrid has actually outperformed dynamic asset allocation in all of these time frames. Data seems to be supporting, not supporting dynamic asset allocation in absolute return terms.
Niraj, I agree with you because obviously aggressive hybrid fund has, almost 75% in equity. So over a longer term, because equity outperforms, it will outperform. I would ideally recommend a dynamic asset allocation fund to somebody who has a more balanced or moderate risk profile. So not for someone who has an aggressive risk profile, because for that person, a higher proportion of equity is obviously more recommended. Dynamic asset allocation funds would have anywhere from 30 to 70% ideally in equity, depending on the market conditions. So this is more suited for someone with a balanced risk profile versus someone with an aggressive risk profile.
So the skeptics argue this, right? That if indeed, and let's work with an assumption that what Salonee is saying, that on a relative basis, aggressive hybrid more suitable for aggressive investors versus a balanced or dynamic asset allocation. And the skeptic would argue that if indeed the investor is aggressive enough, why even go for an aggressive hybrid fund which has got both of these? Over a 10-year time frame, we anyways know that equities outperform by a wide margin. At least history shows that. So I don't give a pure play 100% equity fund.
There is merit to that story. If you can do a 75-35 on your own, you should actually go and do that on your own. But what Salonee says is a lot of truth. There's a lot of truth in what she says. It's very difficult to implement on your own. That's why probably people say, okay, dynamic asset allocation is a better way of doing it. There's 2-3 points which I'd like to point out. When you come to a static allocation, you know what you're getting. You're getting a 75-25 story or a 70-30 story. You already know. In a dynamic asset allocation, you don't know. It can go up to 80% equity also. You don't know. The other part which I'd like to point out is that when you look at asset allocation through a fund is a pool of investors sharing the common financial goal. That is the goal of the fund. All the people in the fund have to concur to that one goal. My asset allocation might be very different. So when it comes to using dynamic asset allocations for an individual asset allocation, then whatever, just hear me out, is that whatever is the asset allocation of the underlying fund becomes my asset allocation. Right? That is a given. So while the characteristics of the fund are in its own place, but my only thing about dynamic versus static is when you get into the fund, you know very well that you're getting this asset allocation. While in the dynamic, it can go anywhere.
Swarup, just a quick follow-up there. That would be true for some other pure play equity category as well, right? To an extent. I mean, the deviations may not be as severe as this, but I'm presuming, and please correct me if I'm wrong, but in a flexi cap fund as well, there would be some degrees of changes that would happen within the market caps that the fund manager would exercise, right? So would that, and flexi cap funds are doing very well. I think in some of your schemes as well, if I'm not wrong, you guys have done really well and people have been advocating Nilesh's funds. So the same argument holds true there too, right?
Niraj, again, I bring to the table that yes, theoretically it is possible. But if you look at the difference between a large cap and now the flexi cap, which was the erstwhile multi-cap, is that, large cap funds by mandate now have to have 80% in large caps. Flexi cap on an average have 75%. They don't go to that so-called cash component. It never happens in the industry. And as the size grows, it is impossible to do that kind of churn anymore. Let's face that fact also. So when these are large funds, these are possible when they are small, 500, 700,000 crore fund that you can be fleet-footed. Very difficult to execute those strategies at larger sizes. So one has to keep that in mind when you look at that probable statement that yes, flexi caps can change, but do they change is a data which I'd like to. That's why we don't have two funds. Because essentially what it would mean is giving the same portfolio in two funds and taking two checks from the same investor. So we've refrained from that and we've stuck to one fund in both the categories. This was before the categorization.
Awesome. Okay. Salonee, I have a counter question to you on this topic before we ask Swarup to speak about where within his AMC can people take advantage of the strategy that he's talking about, right? But like I said, some of the data points do suggest that aggressive hybrid scores over dynamic asset allocation. My question to you is that if we look at it from a perspective of a first-time investor, then the arguments can be, sliced and diced in multiple ways, and your answer would be right, Swarup's answer would be right, and if, God forbid, but if I have an answer, even that would be right. My question is from a perspective of somebody who's not necessarily a newbie, has spent some time, wants to invest in the market, but also, as normal asset allocation should be there, wants some bit of debt in the portfolio. Why would the strategy that Swarup is advocating not be better than dynamic asset allocation? Not for a first-time investor, not for a new investor, for somebody who is reasonably seasoned.
Actually, I think the strategy that Swarup has mentioned would be correct for that person, because obviously that person knows a little bit about investing, about equity, about the market. So they're also able to handle the volatility that comes along with it. Also at that stage, they would have a better idea of what the risk-taking ability is as well, because a lot of people initially say, oh, I can take the risk, but when the markets fall 30-40%, they actually can't. So someone who's a slightly more seasoned investor would have a better indication of that. So for somebody like that, I think what Swarup mentions is exactly the correct strategy to follow.
Okay. So Swarup, before we let you go, how can one take advantage of the amazing data that you've given, the points that you've spoken about right now, if they want to use MIRAE as a house? What is the offering from your stable that you believe somebody can invest in, and what kind of investor should take that up? You're on mute, Swarup.
Here, obviously, I'm talking about my aggressive hybrid fund. It's completed 5 years of track record, and we're quite satisfied with the track record across the horizons, because it's seen fair bit of market traction in these 5 years. It's beaten the benchmark throughout, and so that's the strategy I'm talking about. Interestingly, it hovers between 70 and 77% of equity. Above 75% of equity, we normally rebalance. That's been the track record so far. But interestingly, Salonee, I would really request you, and not to compare my fund, but please compare the standard deviation of the CRISIL's 35-65 hybrid index, which is what this category is about, versus the Nifty 50 on volatility. It is a very low volatile fund. See, what's happened in the industry is very different from what the reality. The story of the dynamic asset allocation has taken a very big step, and actually the story of aggressive hybrid took a back step, because some of these were sold on monthly dividends, which is a missell. Okay, but standalone, if you take out these two, man to man, for a person looking at good returns over a period of 3 to 5 years, this is a good fund or a good category. But like Salonee said, different people have different objectives, and we can both differ and still be right.
Well, that's the beauty. But Swarup, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time, and thanks for the data. It's pretty eye-opening in certain sense, so much appreciate that.
Thank you so much. Thank you, Salonee. Thank you for
Swarup.
your views. It was lovely meeting you. See you. Bye-bye.
Stay safe, Swarup.
Bye.
All right. That's the view from MIRAE Assets, Swarup Mohanty, talking about that particular category. Now, Swarup, Salonee, just before we move on to the other things that we have to discuss, just a question to you. I mean, have you, by any chance, analyzed the MIRAE offering on the category that Swarup was speaking about, or any other offering within this category, and what is your view on the same?
So I have not explored in detail too many funds on the aggressive hybrid category, because in general, as I said, if someone has the expertise, they can look at delineating the two funds and have a separate equity fund and a separate debt fund, because there are some fantastic standalone equity funds. And it also gives you more flexibility in terms of even the market size. So whether you want to be in large, mid, or small cap, it gives you more flexibility to manage your asset allocation in that sense as well. So usually this is not a category, if I were to recommend to somebody, that I would. That being said, if someone is looking at a DIY approach to investing, or as a newbie investor, then definitely that's a category they can take a look at.
Okay, but you would you would firmly believe that it is prudent for an investor, if she or he is willing to take an exposure to an aggressive hybrid category, then might as well do it herself or himself by alienating the two and taking equity exposure directly and taking the debt exposure directly.
Yes, that is what I would believe.
Okay, viewers, that's the view from Salonee Sanghvi on the aggressive hybrid category. Now, Well, let me just flip this. Since we're talking about some equity and some debt, and since we are somewhere around the middle of the year, Salonee, for people who want to put in some bit of money to work from a 6-month perspective, so to say, in the debt category, what is the ideal category to invest in and why?
So I think if you see in the current scenario, what is happening is most banks have been revising FD interest rates downwards. HDFC also recently just cut rates. And also, there's a penalty or a lower interest rate, which is valid when there's a premature withdrawal. So for anyone who's looking to invest for less than 6 months, safety and liquidity is of prime importance. So for this, I would recommend money market funds, which are expected to return about 4.5%. And the portfolio is largely A1+. So that's the highest rated short-term debt that there is, and treasury bills, which is obviously issued by the government. So it's extremely safe. The money market in terms of taxation is obviously taxed at the investor's tax slab. I recommend in this category the Aditya Birla Money Manager Fund. It is among the largest fund in the category and has been delivering better returns versus the other funds in the category. And this is not just over a 1-year period, but this is over a prolonged period. Even if you were to take a 3-year, 5-year horizon or look at rolling returns, it has delivered 4.6% in the last year and over 7% over a 3 to 5 year horizon. So I feel given that for a 6-month period, safety is of critical importance. It is very important to put your money in a fund where you know that your capital will be returned. More than return, it would basically be, return of capital versus return on capital.
And can I ask you what the return on capital is likely going to be, since we don't quite know whether the RBI will hike the rates or no, but judging by where the rates are currently, what's the expected return if somebody puts in the money to work in this category or this fund that you spoke about?
So in money market, people can expect about 4 to 4.5%. This is marginally higher than FD rates, which for most banks hover around 3.5% for a 6-month period. And obviously, if they hold funds for longer than 3 years, then they have the taxation benefit as well.
Okay. And just one last question on this, Salonee. If somebody has a duration which is slightly higher than 6 months, say maybe extended up to 9 months, but less than a year, then would you recommend a separate category of funds, or is this good enough?
I would still recommend the same. There's another category of funds called ultra short-term funds. But the problem with that category is that they also invest in, bonds or debentures, which could be of a longer duration. And, given NPAs are expected to rise over the next few months, we don't know what is going to happen. So even if it's a AAA rated debenture, there could be something on that front. So I think for now, given the economic situation, plus given the situation on the NPAs, this is the safest investment that you can make at this point.
Okay. Towards a bit of safety, necessity of safety in the category in the debt side right now, when investors are looking at less than a year's return, and therefore Salonee recommends, even if your time horizon is slightly more than 6 months, to stick with these kind of funds. The other is, Salonee, a bunch of people. Let's assume I'm actually switching and moving on to the set of investors who are fairly aggressive, right? And let's assume they want to take advantage of the belief that the banking space may do well because loans, the provision, the bad loans, etc., and the NPAs are all provided for. And maybe, just maybe, the equity markets are not giving the large banks their due. And therefore, these people want to invest in thematic BFSI funds. One, are you recommending such funds to your clients right now in the current juncture, based on whatever your thought process would be? So please lay that out for us. And then, of course, I would love you to tell us which are the funds that you believe will give the biggest bang to the buck.
So financial services obviously is one of the most crucial industries in the success of economy, and it follows the growth pattern of any country. In India, the segment accounts for almost 30% of the Indian GDP. So it's definitely a segment that you need to have exposure to. And in fact, the Nifty Financial Services Index has outperformed Nifty across all time frames, especially if you were to look at a rolling 3 to 5 year horizon. Now, the thing is that a lot of large cap, flexi cap funds already have a 30 to 40% exposure to financial services, in line with the in the main index as well. So, for most investors, a separate banking and financial services fund would not be necessary. But for aggressive investors or investors who want to take a tactical call or who believe that they want to be overweight on this segment, this could form a part of their satellite portfolio, because obviously a banking and financial services fund is more concentrated and it is also far more volatile than the broader index. So higher return, higher risk that follows. If I had to recommend a fund in the category, the fund that I like is the SBI Banking and Financial Services Fund. It has basically delivered a CAGR of 18.5% over a 5-year period versus 15% for the benchmark. And it is also far less volatile than the benchmark because it has a beta of only 0.9. Top 5 stocks, mainly the banks, HDFC, ICICI, Axis, SBI, Kotak, account for 65% of the portfolio. And I like this fund versus investing just in the, like a Bs or a passive ETF in the segment, because this also gives you exposure to NBFCs, insurance companies, credit card companies. And I think over time, we'll see more companies in the space being listed. So, those would also be added to this portfolio.
Okay, so a bit of track record, the kind of exposure that they have and the lower volatility makes you believe that this is a good fund to invest into. Okay.
Right.
Great. Salonee, it was lovely talking to you. Thank you so much for taking the time out and being with us today, and look forward to having you more often on our forum.
Thank you so much for having me on the show, Niraj.
The pleasure was ours, and viewers, thanks for tuning into this leg of the Mutual Fund Show.